Dale, Emily, thank you all for joining. Emily, I'm wearing Golden Knights gear just for you today. And definitely just excited to be on. I know it's been a little while since I've done a live stream, but we want to stay committed to the Q&A sessions and definitely like the opportunity to answer your questions on a regular basis here. So that is always the goal. Anyhow, uh, since the deadline on October 16th, probably most accountants are relaxing and taking time off. We've done a little bit of that, don't get me wrong, but we've definitely been focused on improving Prosperity Society, adding content, kind of brainstorming on the types of things that we can be doing to make our platform better, and have gotten some good feedback. One of the things that I'm kind of excited to start working on is a specific section that is specifically related to retirees. And some of the feedback that we got from financial advisors that we were trying to link up with and work with was that they wanted some stuff that was directly pertinent to the things that retirees are asking about. So things like when to start taking Social Security or how to do some strategizing around required minimum distributions or potential traditional to Roth conversion type stuff. And so there's definitely kind of like some meat and potatoes that kind of goes along with riding off into the sunset and being retired when it comes to tax situations. So we thought that was pretty cool and something that we're definitely going to be working on and rolling out over the next like month or two. So something like that is definitely coming. We're always looking to add more content to this platform, and so one of the things that I want anybody who listens to this to know is that you can always reach out to us and say, hey Ronnie, I'd love for you to do more content surrounding real estate or investing in syndications or any of those types of things that might be pertinent to you. And in doing that, it just helps the platform get better for everybody. And that's what we're trying to do with the community. We're over 110 people in the community now and are definitely looking to just grow that number. So continue to spread the word and share this type of stuff with people and we appreciate all the support that you guys have given on this. Now, definitely want to jump into some questions today. Feel free if you have specific questions. I've got the chat open right here and would definitely welcome any of the things that you're specifically wondering about right now. I do have a couple preloaded questions that I kind of wanted to get into. And, we had kind of talked a little bit about some of the, retiree type of stuff. And so I was just talking to a client, and they are specifically concerned. Hi, Sharon. They're specifically concerned about the estate deduction, that exclusion that is out there going down. And in 2026, that number right now sits right around 25 million dollars or something right around there, where if your estate when you pass away is all under $25 million, you don't really need to worry about estate taxes. But if you've done well and your estate is larger than that, then there's pretty stiff taxes that goes along with that. So a lot of times my retiree types will be wondering like, hey, you know what? How can I spread the love? How do I, reduce my estate? And so we were talking specifically about gifting and how the gifting limit is $17,000. So, a husband and wife can gift $34,000 to any one individual without having any of their estate exclusion come off of their $25 million exclusion that they have. So, a lot of people like to try to like stay within that 17,000, per husband and wife, and then shoot that off to a specific individual, like maybe it's a grandchild, or it's one of your own kids or something along those lines. But if you're trying to reduce that estate down, you can gift that money without any tax consequences. If you exceed that number, a lot of people stress out and think that maybe they can't give over $17,000 to an individual. You totally can. It just reduces your $25 million estate exclusion. So if you go over 17,000 in donation or gifts to somebody, there's no real issues with that. You just have to file a tax return letting the IRS know that you gifted somebody over that amount. So anyhow, that's one really good way of kind of reducing that estate. And there's plenty of other things, but a lot of times we try to like link up with an estate planning attorney who really knows their stuff, and try to leverage some of their knowledge on some of that. If you're in real estate, you maybe have heard about something called the de minimis safe harbor rule, and there's a lot of different types of de minimis type things. But back in 2017, in an effort to kind of simplify real estate taxation, they came out with this de minimis safe harbor rule for deducting repairs and maintenance and related to real estate, but also just within business, if you have materials, supplies, repairs, and those types of things that are all under $2,500, that you would be able to just expense that stuff without having to depreciate it on your depreciation schedule. And so on the tax side for us, it became nice because years ago, if somebody bought like a $400 cell phone or something like that, we would have to like put it on a depreciation schedule and depreciate it like $80 a year for 5 years. But now, because of the de minimis safe harbor rule, you're just allowed to expense that stuff. You have to check a box on the tax return, but one of the questions that came out is, what types of properties are included under this rule? And so I know I mentioned something like a cell phone in regular business, but if you're in real estate, if you're doing any type of repairs to your home, like whether it's a rental, it could be a condo, it could be a short-term rental, it's commercial building, it could be anything. Okay, this de minimis safe harbor rule is like it casts a very large net, but if you're spending $1,500 repairing your roof or fixing plumbing or, adding a pony wall or any of that type of stuff, if it's under $2,500, you're able to expense that through the de minimis safe harbor rule, which is really awesome. And just to give you a little heads up, over time, I've kind of gotten people getting a little creative with, how to specifically do this. And, sometimes people try to get, like 3 different invoices from their contractors and have them all be under $2,500. What I would say is just be careful about that. I mean, the spirit of this thing was to definitely make sure that you were just simplifying the process as opposed to trying to game the system or something like that. But in my experience, if like a contractor comes to you and says, "Hey, we're going to replace countertops and we're going to replace the carpet," like, and it's going to be $4,000. If the countertops were $3,000 and the carpets were $1,000, if you ended up like splitting those out on the invoice, I would definitely think there's a spot there for saying, hey, let's expense the 1,000 and then capitalize and depreciate the 3,000. So there is a little, creativity that kind of goes along with that, but really an interesting deduction if you have repairs and maintenance, or you have a lot of real estate, or you're operating a business where you're spending money on smaller equipment like maybe phones, furniture, and different electronics, printers, equipment like that, we don't have to depreciate that stuff anymore unless it's a larger thing. So you do have to make the checkbox on the tax return now, and I'm probably fairly certain now that most accountants probably have that figured out. But for the first couple of years it was out, that was a pretty normal, hey, don't forget to check the box to tell the IRS that you're taking the de minimis safe harbor election. So anyhow, cool question. All right, Sharon says for LP positions and apartment syndications left to our heirs, is there a step up in basis or do they inherit the tax burden also when the apartments are sold? Yeah, that's a great question. And uh, when it comes to real estate, yes, there's stepped up basis, and the tricky part, I guess, that would be really difficult on something like this is how is that pushed through? How does that stepped up basis election kind of come through to the shareholders? And so that can become a little bit tricky. We've had some client situations where that became a factor and it kind of wasn't included in the K1. A lot of times the people that are running the syndication are not going to go order an appraisal on the property or anything like that. So I think there's an entitlement to it probably, but perhaps in practice it might be hard to actually get that implemented. So anyhow, something to think about there. But yeah, I would say that from a basis perspective and that sort of thing, there probably would be some entitlement to that. It's just going to be hard to implement for somebody who's like a 1% owner or something along those lines. So yeah, that's a cool question. Honestly, not something I see very much though. I haven't seen much of any adjustment on that or that type of thing. Maybe my clients are just healthy and I haven't come across that a lot yet, but probably a little bit difficult to kind of manage on that. All right, let's see. I rented our house for about 10 years when we moved to Colorado and had depreciation because it turned into an investment property. Now we've moved back to Texas, back into the same house, and we've been here nearly 3 years and maybe moving again but selling this time. Is there depreciation recapture still in place since we made this our primary residence again? There is going to be depreciation recapture, but the awesome thing is going to be that you're going to have a capital gain exclusion on the rest of it. So you will have a little bit of depreciation recapture, but because you've been there 3 years now, you're going to regain the 121 exclusion, which allows you to take a $500,000 capital gain exclusion against the gain on the property. So that's not going to wipe out the depreciation recapture. You're still going to have that. That won't go away, but you do unlock the 121 exclusion. And for anybody that doesn't know what the Section 121 exclusion is that's just where your primary residence, if you live in it out of the last 5 years, you can get a capital gain exclusion from whatever the gain is. Let's say you bought it for 200,000 and now you're selling it for 500,000. You have a 300K capital gain. If you're single, you get a $250,000 exclusion. If you're married, you get a 500K exclusion. So in theory, there, like where Aaron would specifically be at in a case like this, is he is married. So like if it was a 200, 500 type of thing, um, you're kind of in a spot where you're not going to pay any tax on that transaction other than whatever the capital gain is from the recapture. So, good spot. That's cool. Smart. And oh, those are your numbers. Cool. I didn't know that off the top of my head, but that's awesome that it worked out that way. So, yeah. All right, cool. All right. I'm considering selling another one of our small rentals that has very low basis. What is the threshold income that would allow for zero tax on the capital gain? So, long-term capital gains for married people up to $80,000 in income. So, right at 80K is where like you would need to be under 80K to get capital gain exclusion on that. So for a married couple, if you are under $80,000 of income, like from all sources, then adjusted gross income, then and you have capital gain income and it's long term, so held for over a year, then you would have nothing there. So let's say you're like Sharon and you invest in apartment complex syndications and you get depreciate. You're a real estate professional because you spend 750 hours managing real estate and your syndications kick off losses because of cost segregations, and you don't have a lot of income because of that. Now you're in a spot where you're low income, and maybe you have properties that you 1031 exchanged about 8 years ago. Was it that long ago? If you 1031 exchange about 8 years ago and you have low basis in it because you deferred gains, and now you're in a spot where you have low income. Let's say you sell one of those properties for like, let's say you sell one for 200,000 and your basis in it was 80,000. Now you have capital gain of 120,000, which is going to put you over that threshold, but a portion of that gain is going to be taxed at 0%. So it depends on what your income is, and depends on your situation. But what I would suggest on that, I'm shooting from the hip on some of those numbers, but like 80K is the threshold. But if you're in a spot like that, schedule a tax planning consultation with me, and I'll plug it into our tax software and can tell you exactly where you would be. Carol, welcome in. Thanks for joining. It's always good to have Carol in the house. Thank you. Um, let's talk about let's see. One of the questions I got was centered around kind of managing traditional IRA money when you're in retirement. Best way to schedule a planning consultation is just to email or text me, and I will put you on the calendar. That's kind of what I'm wide open for over the next month or so, is just scheduling those calls. So I'm just plugging that in nonstop right now. So yeah, really good to just get on a quick call. It takes us 15 minutes. We visit a little bit, which is nice for me to visit with you guys. But running numbers is really good for us to do this time of year. Something that I started to talk about though was this traditional IRA. Once you get over 59 and a half, you can you know, withdraw without penalty. Once you get to 72, you have to start taking required minimum distributions. But a lot of times people start asking me questions about kind of managing possibly like a situation where it's like, hey, maybe I should start converting some of my traditional money over to a Roth. And as you guys maybe know, Roth IRA contributions don't give you a tax deduction when you make the contribution, but then as it grows over time, and when you get to retirement age, then you don't have to pay any tax on the withdrawals. And so that's really awesome to have like a deferred tax benefit like that. Have low tax in retirement. So a lot of times people will start talking to me about like these conversions and kind of what the idea is with doing those. And so for some people, like what I will always say is it always depends on people's situations and what they're doing. Some people have a ton of investment income, like interest and dividends, and so like they're not really in low tax brackets in retirement, anyways. Other people are like, hey, I'm retiring so that six figure income job that I have is going to be gone. So I'm really just going to be like living off of Social Security. So, in other words, you're in like the really lowest brackets. So, when you're in that 10, 12% bracket, sometimes people start thinking to themselves, well, why don't I just convert my, traditional money over to a Roth right now while I'm in these 10, 12% brackets, and kind of try to stay within that framework and maybe do that over a 5 or 10 year period. And I think all of that is really smart when it comes to like an idea of tax bracket management, is just trying to take advantage of whatever you can while you're in those lowest brackets is a really great idea. If somebody's sitting in a 37% tax bracket, like I'm never going to ask you to convert traditional money to Roth money unless you are like maybe like 30 years old and you're just going to grow that account for the next like 40 years. But anyhow, if you're in lower brackets, sometimes that traditional to Roth conversion kind of makes a lot of sense. And depending on some other situations, there may be opportunities to do that. We talked about somebody that has real estate and maybe is investing in syndications and is a real estate professional. Maybe they have so much in losses that, rolling over their traditional, converting their traditional to a Roth might be exactly what the doctor ordered when it comes to, like offsetting that loss with other income. So again, like situations matter, and specific situations matter, but like what I would want people to plant in their heads is that, like it's always great to talk about these types of things, lay it all out on the table, and kind of see what the best plan is on them. All right, my investing LLC is a pass through and has an investment in a startup that could potentially return 500K or more next year. Are there investments that I should be looking at that could help reduce my income for capital gains tax? Okay, so one thing that I would want you to know on this is if this generates a 500K capital gain for you, it's probably going to be long term. It's probably going to be taxed right about 20%. So a lot of times there could be something where we can defer the capital gain. It might be an investment in an opportunity zone. In this case, if you wanted to invest in real estate, that's a way that you could defer taxes on capital gains. But a lot of times when I talk to people that have a long-term capital gain and they're sitting at like 500K, I mean, as you guys know, maybe know, capital gains are taxed at a lower rate. And so when it's taxed right at, 15 or 20%, a lot of times people are going to just say, you know what, maybe I'll just pay the tax on that, because if you're not going to do a like an opportunity zone and like roll that money into real estate, there's not really actually like a ton that you can do as far as like other stuff that we would normally recommend. So like high income people, I'm going to be pushing into retirement plans. I'm going to be telling them to spend money on like reinvestment into their business. I'm going to tell them to maybe invest into a conservation easement. But a lot of these types of things require you to like spend $1 to save 25 cents. And so when you're in capital gains situation, you are only paying 20 cents on the dollar. So, you're still kind of in that space where maybe like paying the tax is just going to be what you decide to do, so that in this case, the other 400K is just completely liquid to you. And so that you can use it for other things, invest in other things, and all that kind of stuff. So, anyhow, that's a little bit of food for thought. But like for high income people, I've talked about this, but we've used the conservation easement quite a bit, where you invest in a piece of land, that piece of land gets donated to charity, and you get a charitable deduction, for it. Then follow up question is, this would partially be offset by other capital loss carryovers? Absolutely. So like if you were in a spot where, you get this 500K long-term gain, I mean, number one, the smartest thing to do is to call the financial advisor and in your brokerage accounts be like, hey, I need to sell all my stocks right now that have a loss. And if you do that, you can definitely offset the 500K. Uh, the main thing that I would want to also kind of shoot out on that though is we would want to know the type of income that 500K would be. Like I'm making sure that it's actually would be like a gain on your equity, so like a capital gain, and it's not some kind of like dividend payment that was paid out to you or something like that, or maybe like 1099 income that gets sent out to you as like other income. We'd want to make sure we know the source of that, because if it was something like other income, that's different. That'd be taxed at ordinary rates, and then you would be paying that like kind of top bracket for that type of income. If it is capital gains, though, capital loss harvesting is the strategy that is available to you there, and that works out really well with a conversation with the financial advisor. So yeah, that's a really awesome question. Definitely solid question there. And Al, congratulations on making a cool investment, and if it becomes real, that's really awesome to see something like that come into fruition. Let's see. We talked a little bit about? I guess I got the retirees on my mind right now. But one of the things that is really relevant to people who take required minimum distributions is something called a QCD. Have you ever heard of that before? It's a qualified charitable donation. And let's say you're the type of person that donates like 10% to your church. Like, let's say you're a tithe payer, or let's say that, you have some causes that you believe in, and every year you're, a 10, 20, $30,000 years in charitable donations being shot off to charity. When you have a required minimum distribution, you can do a qualified charitable donation, which will pay the charity directly from your required minimum distribution and essentially make it to where your required minimum distribution is no longer taxable to you. All right, so let me just paint a picture here. Let's say your required minimum distribution is $50,000 a year. If you are sitting in a spot where you're accustomed to just taking that money, maybe they withhold 20% in taxes, you get a net of $40,000, and that's something that happens for you every year. You can reposition that required minimum distribution and say, hey, you know what? Like, I want to pay Wounded Warrior or St. Jude's or, the Church of Jesus Christ of Latter-day Saints, or wherever you end up like pushing your charitable money, you can have the required minimum distribution directly pay those charities. And what'll happen is that $50,000 that you have, depending on how much of it you give away, whatever portion you end up giving away is not going to be a taxable number to you. So if you're somebody that's like sitting in Sharon's position where she's like, hey, maybe I want to sell this house, but like my RMDs are always putting my income at a level to where like the I can't qualify for the under $80,000 AGI number. If you end up pushing that RMD out, then maybe that's a good opportunity for you to keep a lower AGI. So this is called a QCD. And if you've never heard of it, you want to talk more about it, feel free to kind of shoot me a question on that. Aaron, thanks for dropping in, brother. I appreciate you, man. Good to see your smiling face in the picture there, bud. Thanks for coming. Um, let's see. We're kind of probably winding down. We're getting towards the end. If anybody has other questions that they want to jump in here on, I'm kind of winding down on it, getting towards the end here, but definitely want to just let you guys know I appreciate people who are willing to learn and to come into these situations and learn, because some of this kind of stuff that we talk about in settings like this is not always something that comes up just in the everyday conversations with all of you guys. And I mean, I pride myself on being a thorough CPA. I pride myself on an educational component to everything that we're doing. I pride myself on knowing your situations inside now. But the reality is I'm talking to you guys sometimes like 4 or 5 days a year, and there's 360 other days a year where things are going on that maybe I'm not necessarily a part of. And so, people who are willing to engage in this type of stuff, the light bulb tends to go off, and you're like, hey, this is actually something that I could be benefiting from. And it's possible that we didn't necessarily talk about it. And I know that happens all the time with clients and their trusted tax professionals. Every time I get new clients, people are always kind of, coming to me and they just say like, "Hey, I never really got any ideas." And a lot of the new people that talk to me will jump right into like my education platform, and they love the fact that there's something there for them. But I'm continuing to just create the culture of people who like to learn, and within my own practice and within people who are my own age, um, are people who are my own age even, they are not proactive about this type of stuff, and I'm just trying to create that culture. So as you guys do this and as you come to these things and you ask questions, it helps our meeting to be much better than if I'm just fabricating some questions and pushing something out there. So thank you so much for participating in this type of stuff. And I really, really hope that you guys are getting stuff out of this. Anyhow, I'm probably going to sign off for now, but I hope everybody's doing well, and I'm really looking forward to continuing to build on this stuff. And feel free to share with friends. Hope you guys all are doing well, and feel free to let me know any way that I can help you out. Thanks so much.